afternoon, guys. Hope everybody's doing well. Thank you for joining us on this Saturday. This is Real Estate with Ryan, and I'm your host, Ryan Coleman, with Hometown Realty, and my lovely co-host, April Coleman.
Hi, everyone.
Hope you guys are doing well, and thank you for staying tuned with us for all your real estate knowledge, information on the local market, and stats. We've got a great show today. We're going to be talking about 2018, taxes, President Trump's plan, and how that would affect the real estate market. And we're also going to dive into a little bit of stats that happened for end of 2017, sales data that is very helpful if you're thinking about selling or purchasing in 2018, and how that would help you moving forward, whether you're a seller or a buyer.
That's right.
Let's start with a couple of sales and sales data. We're going to break some of these counties down that are surrounding areas, and we're going to split them up in sections. So we'll go half this section and then come back after the break, and we'll come over another couple counties.
Yeah, we have all the listings that have been sold in 2017 with Knoxville and all of the surrounding counties is 22,640 homes. The average sales price is $189,566, and the average days on market is 96. So that is not only just Knox County, but all of the counties.
And those are record numbers. I mean, those are high. They go back to 2002, 2003. If you could relate back to the stock market when the market was moving back then, those are those kind of numbers. You know, we were in the 16,000 to 13,000 before, and now we're at 22,000. So record numbers.
Wow.
Those are really good to know.
Well, we'll break some of those down just by some of the counties that we cover the most here with Knoxville and surrounding counties. We have, for a single family, Knox County, the total homes sold was 8,584, and the average day on market was 49. Then we break it down to Union County. There was 223 sold with 97 days on the market.
That's still pretty good for Union County. Yeah,
Union County,
good.
yes.
So Union County's moving, and a lot of growth, a lot of land out there.
Right.
You're seeing new construction taking off, and so those are good signs for Union County. And Knox, very strong as normal, days on market. What that means, sellers, that if it's priced right, shows right, it shouldn't take long in the market if you got the right agent, marketing the property.
Right, that average 49 is pretty quick, so that's
Good.
great. And we have Sevier County, 1,289 with 88 days on the market, pretty good as well. And then Blount County is the runner-up, 2,208 with 65 days on the market.
Now, we know Blount County, and that's just a large county as it is, and just a lot of growth. You see a lot of the rural areas, that growth that Blount County, Maryville, has not developed. You're seeing economic boom out there.
Right.
With the schools, with the new constructions and the resales, it is really just a hot market. And in really comparison, if Knoxville gets into a hot market or expensive, Blount County is right there. And so it's very close, and we see a lot of transitions. As the inventory shortens, we're stretching out from Knoxville to Blount County.
Right.
And of course, schools are very important for most people there.
Exactly.
Well, we'll break that down, and we'll skip there, and we'll come back and cover Anderson County, Roane County, Loudoun County, and Monroe County after the break. So let's talk President Trump's tax plan 2018. How would that affect your real estate and the market moving forward, and specifically here in East Knoxville and East Tennessee. And I think first and foremost, regardless of your politics, who you're for, who you're not for, I think you got to look at the overall economy. And I guess, individually speaking, are we better off when government takes less money out of our pocket, or are we better off with government taking more money out of our pocket? I think the answer is
simple.
It's simple, but it's not always. If we're going to be innovative and we're going to be stronger when we have more money in our paychecks, more money to reinvest, more money to spend in the community. It's not too complicated when you think about it. If there's more money flowing through consumers, individuals, and business, you're going to see the economy move stronger pace. It's like I say, well, we've got more money from sales, or if you go to that restaurant and then you use the restaurant and then that manager and the servers and then the produce, or go into the real estate market specifically. We're developing a property. Home Depot and Lowe's, you're seeing record numbers, not only in their stocks, but also in their stores. 4 or 5 years ago, when there was a little bit of a retraction, you didn't see as much as that movement. So I think anytime that there's movement, sales, data, limited inventory, buyers are purchasing, the rates are good, it's going to keep the economy flowing. And when people are spending, that I think the biggest thing is the difference is consumer confidence.
Right.
Everybody talks about the interest rates. We're at all-time lows that we've seen in years.
Mm-hmm.
You know, my uncle, he always tells me, he says back in the 80s where there were 18 or 20%, he had an unfortunate divorce and said, picked the wrong time to file divorce in the 18%. So we haven't seen anything like that in a long time. Rates are right under 4%.
Right.
They're the strongest as that they've been. And we're going to see in 18 probably just a gradual increase on the Feds. Shouldn't affect your payment much and shouldn't stop you from purchasing or selling if you're thinking about doing that in 2018.
That's good.
One fact I don't think everybody knows or is important, everybody says, well, is the tax plan, how is that going to affect me in this market? A big stat that I wasn't really sure on until I read it, but it makes sense. Did you know that 50% of Americans are not paying taxes?
I did not.
No. And they pay them in sort, but essentially whether they're W-2 earners, they get money back at the end of the year because they overpay the government, basically. So child earned income credit, things like that, they affect the tax flow. And so 50% this won't even affect.
Wow.
You know, so 50% of the market it will. So just keep that in mind that there's a larger part of the market that's not going to affect, and then there's 50% that will. So let's not get caught into the details. I think the overall plan is positive. It pushes economic growth. It pushes movement, and I think it keeps consumer confidence moving. And there's some negatives about the plan that I think could be done better. But I think with any position or any offer that you get put together, they were able to come to something that I think is going to save us some money. The average person across the year, what you're expected to probably see, you know, kind of net bottom line, is from $1,000 to $7,000 a year. Now, you know, that could vary among, you know, the person that's filing taxes, but the average consumer is probably about $1,000 to $7,000 a year.
A gain.
That's a pretty good gain,
Yeah.
or a reduction in your basis. So I'm a fan of not paying less taxes. I don't know about you, but
Yeah.
keep more money. Let's talk about an important topic, the mortgage interest deduction.
Okay.
They talked about changing that, getting rid of that. They did not get rid of it. Right now, the current exclusion is $1 million. So if you get a loan, anything over $1 million, that interest is not excluded.
Okay.
They've changed that deduction by $250. So it was $1 million. Now we dropped it to $250. So $750, you get a loan, you can write the interest off. Anything over $750, you cannot. So East Tennessee, Knoxville, we have some higher priced homes, lakefront properties. We've got some nice estates around here. But I'd say the vast majority across the country, the average sales price is about $258.
Okay.
So $258 across the country, and certain pockets here, but about $750 on a loan amount. The vast amount of people here in the area is not going to be affected. I think there'll be a small amount of people that are affected. You've got markets like California, New York, Vermont, Rhode Island, some places that are higher priced. Well, yes, that definitely will affect that in the market. But overall, the average consumer, it should have limited to no effect. But let's give a breakdown about that. And so let's just say you had 4% interest and you were paying about $10,000 a year in taxes, and you were at a 25% tax bracket. What you're going to see on that, the difference from $1 million to $750 is about $250. You're going to see about a $2,500 deduction a year that you would not get.
Okay.
Okay, so it breaks down about $200 a month.
Not bad.
Not bad, you know. So every penny counts, and of course, you know, less to the I to the RS is always a good thing. But you know, it's about $200 in that example. So obviously, way lower for a different property. And so, you know, I think looking at that, and then we go back into our state and local taxes, and we'll tie that in. You know, so you have real estate taxes if you own a property here in the county or around the area to your municipality. And so they've something called SALT, state and local tax deductions, and basically right now where it's at, some of your properties like New York, or if you're paying city and county states here in Knoxville, you've got dual taxes if you live in a certain part of the county. They're going to be capped at $10,000.
Okay.
Before there was no cap. So $10,000 now there's a cap. And that's going to affect some higher end markets. So you're going to pay a little more taxes in New York, Las Vegas, certain parts of Las Vegas, but California, they're not liking Trump at this point.
Gotcha.
But
So it was already high and it's going to be higher.
Right.
Gotcha.
So we're coming up on a hard break, and remember, we're going to finish up on some of this Trump tax talk, and we're going to be talking about HELOC loans. We've talked about pass-through entities, which is very, very important. And there is some depreciation that we're going to be talking about that they've changed, which is going to be good if you own commercial property coming through.
Okay.
You're listening to Real Estate with Ryan, and thank you guys for staying tuned. And we're going to see you guys on the other side of the break.
Perfect.
In the competitive real estate market, Ryan Coleman has a track record with guaranteed results.
Ryan made the sale of our home seamless. He was there every step of the way.
And our home sold the first week for full price.
With his knowledge and expertise, he took away all our worries.
And he got us much more money than we had ever expected.
Ryan is so confident that he will sell your home, he's willing to put his own money on the line. If he can't sell it in the time frame agreed upon up front, he'll buy it himself. Ryan Coleman with Hometown Realty, your home sold guaranteed.
Hey guys, thank you for staying with us after that break. We were talking about President Trump's tax plan, and there's so much to talk about, so we're going to try to cover these topics fairly quickly, but thank you for staying with us on a Saturday.
Yeah, we're going to finish up those statistics real quick for the homes sold in 2017. Anderson County, 937 were sold with 71 days on the market. Roane County, 623 were sold with 89 days on the market. Loudoun County, 1,007 with 83 days on the market. And Monroe County, 528 with 109 days on the market. So that's just a comparison that from last year and then how we can go into 2018. But remember that there was also 50% of the homes that came off the market that did not sell, and they did not move. So just remember that you need to hire the right agent. That makes the difference to selling that house, which of course you can always call us if you want further information on that at 693-SOLD.
It's always about marketing. You've got to push it into the space. The old saying is that they don't know about your property and they haven't come in and take a viewing, it won't sell. So we've got to drive traffic through the door, and you need an aggressive agent out there pushing into the space.
That's right. So
those are good numbers, and I think overall assessment, like April said, numbers are record, and I think we're going to see that in 2018. We'll keep seeing inventory down a little bit, so it's important that we get out there. And I think I'll recap with this, as we're dealing with the weather and going into the winter season, not far from spring, I think it's so important that you get the home on the market, get out in front, because we're going to see a big rush here in the spring. Everybody's going to be pent up, and we're going to see a lot of inventory hit the market in the next 60 days. And so it's important that more competition, as if you're a seller, doesn't help us.
Right.
You know, less competition always means more pricey. So to keep that in mind. So we were talking about the state and local tax deductions. Basically, between the state and local taxes, if you take your mortgage interest and you take your taxes on your property, you could be looking on $1 million property, which is now $750. The difference from 2017 to 2018, you may be looking at about $300,
okay.
$3,600 a year. Okay, so you may lose those potential savings, but there's other places in the plan that make up for it. And we're not going to get into the weeds about everything in there, but there's places that I think overall it will be good. And most of East Tennessee will not be affected. But again, $300, if that's stopping you from buying your luxury property, you may have the wrong buyer.
That's right.
Yeah. So I don't see an issue there. Okay, but that's moving on from that. One of the important things I think that we've used for a while, a lot of our credit unions have used, is our HELOCs. If you know what a HELOC is, it's called a home equity line of credit. And for the previous administration or prior, they've always been used as a tax write-off, meaning that the interest can be written off every year on your taxes. So if you pulled equity out of your home, if you want to do an improvement to the property, kids going to college, consolidating some debt, whatever you want to use it for, it's always been interest deduction, which was a good thing. No more.
Oh.
No more. So the HELOC is gone, and there's no more interest deduction. I mean, you still have access to your local credit unions and banks, but you will not be able to get the interest deduction on that.
Gotcha.
There's some other ways you can get around that and creatively, and you can always talk to us about that. I'm be glad to give you any advice that we have, but no more deductions. Now, investment property. Keep in mind, investment properties, you can still do a HELOC on that investment property with our lenders, and of course we'll be glad to give you our vendors. And that is able to be written off because an expense. Anything on an investment property is always going to be able to be written off. and so that's important. So HELOCs will still come into play because it's investment property.
Okay.
All right?
But
So
do you think that that when people are trying to upgrade their home, now that they're not going to get that deduction, do you think that less equity lines will be taken out?
I think you're going to see the banks weren't charging a whole lot of money on those anyway.
Okay.
A lot of our credit unions, they were fairly free or inexpensive to open. That's why so many people would open them.
Okay.
So
Probably not.
I think we'll see a decline in applications on them, but eventually, I think you may see an increase or a steady for investments on HELOCs out of the properties, because let's say you've got an investment property that's paid off, you may use that collateral as other properties that you're investing in or flipping or doing some other investment versus using your liquid cash or dip it into a savings account.
Gotcha.
Then you could just use your credit line there, and it's interest deduction, and you can write it right off. So it probably makes more sense to pull that equity line if you got an investment property that's got the equity to do that and get the deduction there.
Okay.
So we'll move on there with depreciation. So assets, what a depreciating item is obviously over time, as a home gets older, it declines in value some. And so the government allows you to write that off. It's called depreciating over time. So if you're familiar with President Trump and his runnings of the political office, you knew that they were talking about that maybe he didn't pay taxes. And he owned a lot of commercial real estate, multifamily apartment complexes, big buildings, right? Commercial properties. So the bigger the properties, you're allowed to roll those commercial properties. Right now, the rules were 39 years to 27.5 for residential. So 39 years on a commercial property, you could depreciate that asset over your tax return. The larger the asset obviously allows you to pay less basis on your taxes and pay less money to the government, which is always a good thing. So current rules, 2017, 39 on commercial, 27.5 on residential. Now, the change on it, residential has changed to about 25 years. So about 2.5 year change. Not huge, but every little bit counts, right?
Right.
Commercial is massive. So if you guys invest in commercial property, buildings, multifamily, anything more than 4 units, that's investment, commercial, 39 years is at 25.
Oh, wow.
We say, Ryan, what's the big difference? That's called forced, that number's forced down by 60%. So, for example, if you were claiming $2,000 on the depreciation, now you went to $4,000 or $4,500. Okay, so that's more reducing. And obviously, the higher the property on commercial, the bigger the gain, the bigger that you offset on your tax basis, which in return helps you lessen your amount owed to the government.
Okay.
So that's really, really good, and I think you're going to see the commercial market in 2018 and moving forward. We've already seen a big pickup there, but I think you're going to see more of that there, that structures on that. So I think that's pretty good for commercial. Residential, a little help as well. So we have our pass-through entities, which are our LLCs and corporations, and versus our service providers. And we'll try not to get in the weeds on that, and I'm not an expert on this. We always like to give a disclaimer. We're not your CPA or tax advisor. We're just real estate brokers and try to give you the information as what we see it and some of our trusted source of what we find. So we always encourage you, make sure that you reach out to your trusted source for that information. But this is how we see it. So if you're familiar with entities, a lot of people are purchasing real estate, whether it's investment properties or things like that. They're purchasing them in an LLC or a corporation name. And there's some tax advantages there, but basically they're trying to protect the asset from claims individually. And of course you're trying to avoid the self-employment tax. So we pass through entities, basically self-employed individuals, or that money flows through on a K-1 and it passes through that entity and basically comes to your personal return. So, and then you have service providers. So they've broken down into 2 categories. Service providers, which would be real estate brokers, attorneys, engineers, people like that, actors, things like that. There's a category for that. And then there's a category for your LLC corporations and your contractors and things like that. What's important and really short on that is there's a 20% exclusion off your basis, meaning when that pass-through entity, let's say you were to gross $100,000 on the LLC and corporation, they're going to give you a 20% deduction right from the get-go, with no limit on the LLC and corporation contractor side, that example. So if $100,000, you're going to pay $80,000 on your basis, 20% is right there. So that's a huge savings.
Meaning tax?
Yep, tax liability.
Taxes only on 80 and not 100.
You're going to limit your liability.
Oh, okay.
Service providers, there's a little bit of there's some great advantages there, but there's a cap.
Okay.
And for a single individual, it's 157,000. Married is 300, ballpark. Don't hold me to the number,
A little
guys.
bit more.
It's 300 and some change. So 300 married, that applies. If it goes over that, it does not apply.
Okay.
So in short, there's some huge deductions that, along with the standard itemized deduction doubled, and you can see some real estate there. It's just really a great advantage.
Wow.
Well, guys, we try to touch a lot of topics today. We appreciate you guys staying with us. You're listening to Real Estate with Ryan every Saturday, 5 o'clock here at News Talk 98.7. Again, I'm Ryan Coleman, your host, along with my lovely co-host, April Coleman. And every Saturday, 5 o'clock, catch us here. Visit us at ryancoleman.org, or you can always call us at 693-SOLD. Or definitely, if you didn't miss this show or caught pieces of it, catch us online on Facebook or on YouTube. Thank you guys for joining us this Saturday, and we look forward to seeing you next week.
Have a great day.
Thank you.